October 2025, the month the market shook. Bitcoin didn't just fall. It tumbled like a domino, pulling everything down with it. Within hours, more than $19 billion worth of leveraged crypto positions were wiped out. People watched their portfolios bleed red, screens flashing liquidation after liquidation. But what really happened that night? Was it manipulation? Was it fear? Or was it the inevitable correction that every euphoric cycle invites? Let's go beyond the headlines and dive deep into the truth behind the October 2025 crypto crash, why it happened, and what it says about how humans behave when markets crumble. Because this wasn't just a financial event, it was a psychological mirror showing us who we really are when money disappears. The build-up, when greed replaces logic. Before any crash, there's always a storm brewing in silence. Through August and September 2025, crypto markets were euphoric. Bitcoin had broken new highs, trading above $125,000. Ethereum hovered near $4,000, and even the smaller altcoins Solana, XRP, and countless meme tokens were exploding. Social media was full of to-the-moon chants, and every newcomer believed they'd caught the next golden wave. But under that glitter lay a dangerous secret: leverage. Investors were borrowing money, sometimes 20x, 50x, even 100x leverage, betting that prices could only go up. The more they borrowed, the higher prices climbed, a bubble quietly expanding with borrowed air. On-chain data from multiple exchanges later revealed just how fragile the market had become. Billions of dollars of leveraged long positions were sitting inches away from liquidation. One wrong move, one small shock, and the entire tower could collapse. Meanwhile, institutional inflows, the big money coming through ETFs and hedge funds, had started slowing down. Global uncertainty was rising again, inflation fears, oil price spikes, and new talk of tariffs between the US and China. Stocks were turning shaky, yet crypto traders ignored every warning sign. They were convinced that the bull run was unstoppable. It was the perfect setup, a system overloaded with risk, floating on confidence, and waiting for a spark. Bitcoin dropped almost 10% within hours, falling below $115,000. Ethereum plunged 15%. Solana and other altcoins crashed as much as 30%. In that same window, $19 billion in leveraged trades were automatically liquidated. It was a domino effect. Once liquidations began, each forced sell triggered another, spiraling prices downward. But the real shock wasn't just the tariffs. Analysts later found signs of coordinated sell pressure, possibly from large market makers or algorithmic trading bots exploiting thin liquidity. Some on-chain data even hinted at manipulation, a $60 million sell order placed strategically across multiple exchanges that set off the first wave of liquidations. In a market that was over-leveraged and emotionally charged, that one spark was enough to light the fuse. By midnight, crypto Twitter was in chaos. Hashtags like #CryptoCrash and #BitcoinDown were trending globally. Meme coins went to zero. People begged exchanges to unfreeze withdrawals. And yet, for those who've been in this game long enough, it all felt eerily familiar. The cascade, when machines take over. Once the price started falling, there was no stopping it. Exchanges automatically triggered liquidation orders to cover margin calls. Traders who had borrowed too much lost everything in seconds. Each liquidation created more sell pressure, causing further price drops, a death spiral that no human could interrupt. Liquidity vanished. Order books thinned out. Even moderate sell orders caused massive price swings. Altcoins, the smaller ones especially, collapsed 50%, 60%, even 70% in a single day. Meme tokens that were worth billions a week ago suddenly traded for pennies. Institutional investors who had entered the market through ETFs and crypto funds began pulling out capital to avoid deeper losses. Liquidity drained from the system. Retail traders panicked. What started as a technical correction turned into a psychological breakdown. Interestingly, Bitcoin still held relatively stronger than the rest. Many traders began converting altcoins to Bitcoin as a safe crypto asset, similar to how investors move into gold during equity crashes. That shift showed something crucial. Even during a panic, faith in the core of crypto remained. The human factor, fear, greed, and chaos. Every crash exposes one thing: human emotion. Markets don't fall because numbers change, they fall because people react. And when panic sets in, logic dies. During the October 2025 crash, that emotional spiral was on full display. At first, investors told themselves it was just a dip, a buying opportunity. But as the red candles kept growing, fear began to take over. The brain's survival instinct replaced rational thought. The goal was no longer profit, it was escape. Some traders sold everything. Others froze, watching helplessly as their holdings evaporated. On social media, panic spread faster than price updates. Influencers who had been shouting by the dip went silent. Memes turned into mayhem. And amid the chaos, whales, those holding massive capital, quietly began accumulating again. This is how markets work. Fear makes the weak sell cheap. Patience lets the strong buy opportunity. Behavioral economists have a term for this: loss aversion. The pain of losing money is far stronger than the joy of gaining it. In times of panic, this bias drives irrational selling. Another bias, herd behavior, multiplies the effect. People do what everyone else is doing, even if it's wrong. The result: a self-fulfilling crash. Think about it. Every trader claims to be long-term until the screen turns red. Then long-term becomes get me out now. But amid all this chaos, there's also wisdom. Those who understand emotion and control it are the ones who survive every cycle. The October 2025 crash reminded us that investing isn't just about charts and indicators. It's about psychology. The aftermath, fear turns to reflection. In the days following the crash, the market began to stabilize slightly. Bitcoin hovered near $110,000, forming a temporary floor. Altcoins tried to recover, though many remained down 40% or more. Analysts flooded the media with theories. Some blamed geopolitics, others blamed leverage, and some even called it the Great Cleansing. Because, in a strange way, that's exactly what it was: a cleansing. Crypto had grown too fast, too euphoric, too reckless. The crash washed away weak hands, fake projects, and over-leveraged traders. What remained were the true believers, the disciplined ones who understood that innovation doesn't end with a price drop. The same thing happened in 2018, in 2022, and again in 2025. Each time, people called it the end. Each time, crypto rose higher than before. The lessons: 5 truths from the crash. The first lesson: risk management isn't optional. Leverage can amplify gains, but it can destroy faster than it builds. No investor should ever risk more than they can afford to lose. The second: diversify intelligently. Never put all your faith or your capital in one coin or one trend. Markets are unpredictable. Survival depends on flexibility. The third: understand your time horizon. If you're investing long-term, day-to-day swings don't matter. But if you're trading short-term, volatility is part of the game. Plan for it, don't panic from it. The fourth: watch the data that others ignore. Open interest, liquidation volumes, and on-chain metrics often tell the story before price does. The next time everyone's euphoric, look at leverage levels. That's your warning sign. And the fifth: control your mind before you control your money. Emotions are the real market movers. Learn to detach. The best investors don't react to fear, they read it like a signal. Where do we go from here? So, what happens next? Can the market recover? Absolutely, but patience will be the deciding factor. Every crash in crypto history has eventually been followed by innovation, rebuilding, and new highs. After this October crash, we'll likely see more regulation, cleaner exchanges, and better risk practices. It may take weeks or months, but recovery always begins in silence when fear turns to curiosity again. For now, the key is caution. Watch Bitcoin's support levels near $110,000. Track ETF inflows. If institutions start buying again, confidence will return. Don't rush back and all at once. Average your entries over time, because this is what separates survivors from victims. Discipline.